You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. Hello, all you budgeteurs and budgeteers. Great to have your company for another episode of the Savings Tip Jar, episode 152. And yes, the federal budget is out, so plenty to talk through today. I'm Dom Beattie, the editor of Savings.com.au, alongside our senior finance journo, Denise Raywood, to help break down the week's main money matters, including the federal budget and what it means for us savers, plus the latest savings account rate rises following last week's RBA hike, and how savers might be getting left behind on that front, and the interesting insights from new home loan data that's out today from the ABS. After that, we'll get an expert reaction to the federal budget from Emeritus Professor of Finance at UNSW, Peter Swan, who doesn't hold back, so trust me, you don't want to miss that one. And as always, we'll each share some savings tips. Hey Denise, how are you? Is your head feeling sore like mine after poring over all those budget papers last night?
Yes.
Certainly feeling it, although I'm battling a cold as well, so that's not fun.
No, it's, it was probably the most exciting budget that we've had to cover for a while. Some sort of major things and not just nibbling at the edges things.
Yeah,
of course,
true.
There's always a lot of nibbling at the edges anyway. So you're bound to find that if you go looking. But yeah, there's a lot to talk about.
Yeah, absolutely. But the first thing we'll talk about, as we usually do on the podcast, is our savings tips this week. What's yours?
Well, my savings tip, and it's sort of a bit timely, I guess. I'm at a certain stage of life where, things can get a bit complicated financially. I actually took the step of going to a financial planner, and I had not done that in the past because, as we know, it can be a bit of a commitment. It costs about $3,000 for an initial appointment.
Wow.
They're very thorough, and I just thought it could actually turn out to be a very good investment because they're just across so many things that, even in the field that we work in, Dom, there's little things that they know from experience, a lot of tax stuff, minor stuff. And I found it to be quite a useful exercise, particularly when things get complex and there's certain paths that you could go down. They can actually monetize and tell you, what you will get pretty much to the cent or the dollar from going down one path over another. And I found that very useful.
Wow. Yeah, I didn't realize financial advisors or planners actually costs that much. Actually, there's another question. Is there any difference between an advisor and a planner?
Yeah, that's a good point. I don't know. And
this was a planner you went and saw, right?
Yes. And
so that sounds like they've put together a proper plan for you, whereas maybe an advisor just keeps it quite general.
They did. They were at pains to point out that they can't give tax advice. And so they encourage you to get that from another source, which is interesting. So, there's been a lot of legislation handed down over that particular sector, as we know. So I think they're very careful with how they couch the term advice. And, that's really another reason why you have to pay so much for it these days, because it is very individualised advice, as I was to find out. So, I think it will pay dividends for me over a longer term anyway.
Okay. Yeah, well, I dare say that's why people are happy to spend that money, is in the hope that they'll discover something that will yield them much greater returns or much greater savings on their finances. So, nice one. That's I don't think we've heard that before, and shed some light on the cost of a financial planner as well, because I didn't actually know myself personally. My savings tip this week is bit of a just sort of general one rather than a specific deal or anything I've come across, like I often say. But this one is just don't let social media inflate your standards. What I mean by that is, your standards of what a standard wedding should look like or cost, or even a kid's birthday party or a holiday. I keep thinking of that old saying that comparison is the thief of joy, which of course is not the case when it comes to comparing financial products. Obviously, we're in the comparison site industry, and you can compare financial products at savings.com.au. But yeah, no, I do think though it is true when it comes to social media, because so much of social media, particularly Facebook and Instagram, not so much those sort of discussion forums like Reddit or X, is simply people showing off their highlights, which I feel creates this false perception in users that everyone is traveling overseas, or everyone's traveling a nice car, or everyone's having expensive $50,000 weddings. And as a consequence, I feel like younger generations, millennials and Gen X, millennials and Gen Z, rather, are spending much more on luxury things like overseas travel, cars, parties, and weddings than boomers and Gen Xers did when they were the same age. And obviously, you're a Gen Xer, Denise, and
thanks for that, Dom. I thought you might have put me in the boomer category, so I'm pretty happy about that.
Not. Yeah, I know you're not that. But yeah, you did 2 years of traveling in your early 20s, but yeah, that wasn't the norm in those days. And that's despite the tougher financial circumstances younger gens of today face compared to when, like I said, those older generations were their age. So something's not quite adding up, and I feel like social media is to blame. So yeah, my tip is just try not to be influenced by social media into thinking you need to spend $50,000 on a car or $50,000 on a wedding or have an international holiday every year. And perhaps the best way to do that is to stay off those platforms. What are your thoughts on that, Denise?
I'm with you, Dom. There's certain things that just didn't exist in my day, and one of them was those baby reveals, baby gender reveals, whatever.
Don't get me started on those.
I don't. Yeah, that escapes me. I don't understand the purpose of that. I don't want to sound like an old whinger, but there's definitely things that seem to be confections for social media that you don't really need to go too crazy on. Keep your life simple. It's a pretty good way to live, I think. Just make things simple. And I think, trying to remember how much we spent at our wedding, I think it was under $5,000. It was probably in the 90s. It was pretty cheap.
Incredible. Yeah.
Pretty cheap in the day. And it was fine. You don't think too much about it for too long, put it that way.
Well, we're literally thinking about a backyard wedding. We've been engaged for 5 years and just thinking of like, how much does it cost? But we're not naturally people that like love the spotlight or anything. Or maybe that's a surprise to people, but when it comes to me, but definitely my partner, she doesn't really want everyone looking at her and a big deal made about it all. So she'd much rather the backyard simple wedding, and maybe we get a is catered but with like a pizza van or something, and lots of cartons of beers in an esky for people and
sounds
something like
great,
that.
Tom.
And it does sound good. Like there's less stress, and there's more money that we can spend on other things. Like we want to make improvements to the house, and maybe travel. I don't know, but that's just the thought of spending $50,000 on one day. Maybe it's the Scot in me just really
that does come through a lot, Dom.
Idea.
Yes,
yeah.
But in this case, no, definitely you're on the right track.
Okay, good. All right, let's get into some news then. So we'll start off with the big one, the federal budget. So Denise and I and the rest of the team were up quite late into the night, poring over the budget papers and cranking out some stories on this. I put out just a general piece covering, how will the federal budget impact savers, and I actually said that this one could prove to be the most impactful budget in decades, with some pretty far-reaching consequences for any Aussie that's striving to save, build wealth, and get ahead. And the reason for that is, the big one I'd say is capital gains tax. Which, it's going to impact any saver that invests their spare cash, as we're often encouraged to do. So essentially this one, capital gains tax, will revert to its pre-1999 inflation indexation method for capital gains on all assets after 1 July 2027, and the 50% tax discount won't be available. Although I must stress that that's on assets held for longer than a year. So if you actually buy and sell an asset in less than a year, the capital gain will be taxed entirely, like including in any inflation. So it will be the nominal gain that is taxed, not the real gain if it's held less than 12 months. But yes, assets that capital gains that accrued before 1 July 2027 will still receive the 50% tax discount, and investments in newly built properties will retain the option actually of either the 50% tax discount or the new indexation method. So obviously they still want to encourage people investing in brand new property. But also the government has introduced a minimum 30% tax on capital gains, which prevents people from waiting to sell an asset until a year where their taxable income, say, was in the 16% bracket or even lower, and that 16% bracket is actually falling to 14% from 1 July next year, which was announced in the last year's federal budget. So that one's not a new one. And the other aspect there is pre-1985 assets, which have never been subject to capital gains tax, will have capital gains accrued from the 1st of July 2027 taxed with the indexation method. So it's an interesting one. With that one, it could actually end up that in situations where inflation represents more than half the asset's gain, say, for example, the capital gain was 5%, but inflation for that year was 3%. This could actually result in less capital gains tax than under the previous 50% discount method. So that's worth keeping in mind. So that's capital gains. Then we'll move on to negative gearing, which is the other big one. So from the 1st of July 2027, the tax benefit of negative gearing, as in the ability to deduct losses from negatively geared properties against other income, will be restricted to newly built properties. Properties that are currently negatively geared will be exempt from this change, so the tax will benefit for them continues, so it's grandfathered. Those might be thinking of rushing into the market now to negatively gear property before the 1st of July. We'll only have this benefit until 1st of July 2027. That's the other one there. Another one, which I don't know, we were kind of questioning, why have they done this? Like, I don't think anyone's jumping for joy out of it. They obviously think it's a bit of a budget sweetener, but I think most people are just kind of laughing at it. It's that from 2027-28, all workers will be eligible for a tax offset of $250 on earned income. So this one's called the Working Australians Tax Offset, or WATO, I think it's pronounced. And it will be permanent and annual, and set to benefit the 13 million workers we have in Australia. This one is similar to the old 1,080 low and middle income tax offsets, which was nicknamed the Lamington, except obviously it's substantially less, and it only applies to tax paid on income that was earned, that is through work, as opposed to other income such as passive income such as rent, dividends, or capital gains. But really with it not kicking in until the 2027-28 financial year, that means workers will not receive this $250 tax offset until after they submit their tax returns from July 1, 2028, which just seems an age away. Think about how much inflation is going to eat into our lives and raise the cost of things, that this $250 will just be a drop in the ocean, just be easily absorbed by everything else going up in price, I think. I think, another one is minimum tax on trust distributions. So similar to the minimum 30% tax on capital gains, there'll be a minimum 30% tax on discretionary trust distributions from 1 July 2028. But there will be some exemptions for, like deceased estates, charitable trusts, super funds, and, some income related to like farms and vulnerable youth. So, those were the main aspects. Obviously, the budget, as talked about, other things like the $1,000 instant tax deduction for workers, that one's already been announced, and it's known about for quite some time. And the tax cuts, which were announced last year, with the lowest bracket, the 16% tax bracket, falling to 15% from 1 July this year, and then 14% from 1 July 2027. So that's the main stuff for savers, I reckon. Denise, what do you think of all that?
We sort of knew most of it. As you said, I think I hadn't heard about the pre-1985 being affected for the capital gains tax. So that was something I found out last night. Something else that I thought was new was that minimum 30% capital gains tax on assets sold after
that was
a
a
certain
surprise.
time.
Yeah.
I hadn't heard that. So, there's always a few little things that you pick up in every budget that haven't sort of been floated or leaked publicly beforehand. So there were a couple of things that I saw. My specific brief last night was looking for things in the budget for pensioners and older Australians.
And that was a challenge.
I did find it quite difficult to find those. There was a few aged care things, nothing very specific considering the aged care tsunami that we're supposedly in at the moment. There was there's probably a lot of disgruntled people today, and they're starting to come to the surface just in the commentary with what we've seen, and certainly our guest Peter Swan.
Yeah, I was going to say, speaking of disgruntled,
he's got a few interesting things to say. That's definitely worth a listen. It's probably the most far-reaching federal budget that I can remember. For a long time.
Yeah. That's decades.
Yeah, it was, most of it was out in the open. It did happen. So, I was wondering how much of it would be wound back or whether they were just testing stuff out to see the electorate. But, most of what they said, is there.
Yeah, for sure. Yeah, we could talk all day about the federal budget, and there's obviously we've got a lot to get off our chest on that, but I think we might have to bite our tongue just because we're running out of time, and we've got our chat with Peter Swan coming up. So you can hear plenty more of our thoughts as well as his thoughts on the federal budget in that chat there. But let's move on to some of the other news in the world of finance for Australians this week. And obviously, it seems so long ago now, but the RBA did hike the cash rate last week, and we're still seeing some of the aftershocks of that, particularly in the savings account space, where banks are now starting to apply the rate increases there to some savings accounts. And Denise, you're keeping an eye on all that. So do you just want to run us through some of the main highlights there?
Yeah, I usually keep an eye on savings rates after rate movements from the RBA. This is our third consecutive rate hike for 2026. And I do get the feeling that savings rates have been a lot slower coming through than they generally are in the past.
It seems that way.
We still have two of the big four who haven't shifted their rates yet, NAB and ANZ. They may come through maybe by Friday.
Well, they always do it 10 days after the announcement, the RBA's announcement. So, yeah, they'll all be going up by then, surely.
Surely. But then I'm thinking, are there some that won't be hiking their rates because in their minds they've already passed on to savings account rate increases? Of course, we see lenders are always very quick to pass on rate hikes. They tend to drag the chain a little bit when it comes to passing on savings. I'm curious to see. Sometimes savings hikes are just sort of put on websites, or they may get sent out via an app or emails to people. They sort of don't get the prominence, which is funny when it's hikes because it seems like that it could be, good news, and maybe you should highlight it a bit more. Maybe institutions are feeling like they've passed on enough savings rate hikes so far this year, and they're seeing what they may be able to get away with.
Yeah, well, I mean, I was actually in the paper last week talking about why savers might actually be left behind by some of these rate hikes, because while on the surface it looks like for example the big four banks are all passing on the hikes in full to savings accounts, and at the same time as home loan hikes, like I said, 10 days after the announcement. But if you actually dig a little deeper, scratch below the surface, you'll see that actually, if you break down these hikes, it's not like they're always passing it on in full to the base rate of this savings account product. Often you'll see the rate hike or part of it is passed on to the bonus rate component, as in the rate you only get when you meet the bonus criteria. Or, and this is what I find probably most egregious, is the intro rate. Because that means existing customers with that savings account product are, I mean, particularly if the rate hike's being passed on in full to the intro rate component, those existing customers with that same product are just missing out entirely on the rate hike, because they're obviously past that. I mean, it's usually 4 months, the intro period. If they're past that, they're just not getting any increase at all. So people really need to pay attention to that sort of thing. But I dare say if you've got an intro rate product and you've just let it elapse beyond the 4 months and you're still there, you're probably not someone that's that tuned into your finances anyway. But yeah, I find that it just seems a bit wrong. Like if you want to be totally fair, and pass on to everyone, you'd pass on the hike to the base rate, as in the rate that you don't have to. It's an ongoing rate, and you don't have to jump through hoops to earn it. So that's something that sort of grinds my gears a bit. But that's the big four. Other banks, I think AMP Bank Go with their Go Save product seem to be the fastest. That's, I think, 2 or 3 hikes in a row that they've passed on the hike in full in 6 days, which is pretty market leading in terms of the pace of passing it on. So it's worth, you got to call out good behavior as well as bad behavior. So well done to them. But there have been some other banks that have been quite coy. We're not sure what's going on there. And we're still waiting to hear from them. And we just wonder if they've got something to hide. Are they only passing it on to the bonus rate, or are they only passing on part of the rate hike? Stay tuned to Denise's article on Savings.com.au, which is updating daily on which banks are passing on the RBA rate hike onto savings accounts. But we've got some other news that's kind of broken just earlier today. And the ABS has released lending indicator data, which only comes out 4 times a year, which is not enough for us finance nerds. It used to be every month, I think. But
it did.
They've now reduced it to quarterly. You've been poring over those numbers this morning, Denise. What have you found?
Yeah, well, we've seen record investor lending over the previous 2 quarters. So the September quarter last year and the December quarter last year. And of course, that was on the back of 3 interest rate drops in 2025. In October, we saw the 5% deposit scheme expanded. And that brought a bit of a flurry towards the end of the year in the housing market of people sort of taking up those opportunities. And now for the March quarter figures, we've seen a drop across the board in all lending types, owner-occupiers, including first home buyers, and also investors. Probably owner-occupier lending fell the furthest, and that was in the number of loans, 6.9%. And in that time, the March quarter, we saw the February and March rate increases for 2026. Of course, that has flow-on effects for home loan serviceability, and it also makes would-be buyers a little bit less confident in going into the market, knowing that interest rates are on the upturn again. They may be just waiting to see. But there you go. We've seen, even before the federal budget changes kick in to property investors, we've already seen a bit of a downturn just on the back of probably interest rate increases, maybe a bit of uncertainty about the economy and inflation with the conflict in the Middle East. The sentiment behind taking out home loans has already slowed. And we've also seen property market analysts saying the same thing with their data. Prices are softening, particularly in the main Sydney and Melbourne markets. And that seems to be playing out with how buyers are regarding the market as well. It'll be really interesting to see how the lending data stacks up with, in the wake of this federal budget, particularly those investor figures. The Commonwealth Bank brought out a revised housing outlook update today, and they had originally forecast 5% growth nationally in dwelling prices. They're now saying probably about 3%, given what was in the federal budget last night. And it's quite interesting because they said that, there could be such a short-term drop in investor sentiment that, that could fall a bit further than that even. So, things are changing. It can be good news and bad news, depending on what side of the coin that you're on, whether you're trying to get into the market, whether you've recently bought and aren't too happy with prices dropping already. But anyway, that's the housing market for you. It can't keep going up and up forever. And I guess we're seeing that now.
Yeah, you get the sense that we're seeing the turn of the worm that is the lending, investor lending growth. I feel like we've probably just passed the peak now.
Yeah.
And it's because I just can't see it picking up anytime soon, particularly with interest rate rises, but also these changes that have just been announced by the government with negative gearing and capital gains tax. Obviously removing some of that incentive to invest in property. And then on top of that, you've got softening markets particularly in Sydney and Melbourne. You're still seeing other parts of the country are doing very well, but maybe things will start to slow down in the likes of, Brisbane and Perth and Adelaide and Darwin, where we have been seeing, like 20% growth per year in some of those cities. So, yeah, you wonder if we're coming into a period where property prices will stabilize for a little bit. But, as our next guest suggests, some of those changes may not actually impact the housing affordability too much, and we'll probably still see property prices going up. So it's going to be all this stuff is going to be great case studies for uni textbooks many years from now, and people can look at what to do, what not to do, and what impacts what in the market. So yeah, it's all very interesting. It's grist to the mill for us finance journos. All right, time to talk to our special guest. All right, so for this week's Dollar Dialogue, we're going to talk some more about the federal budget, but this time getting some expert reaction. And for that, we're joined by Emeritus Professor of Finance at the University of New South Wales, Peter Swan, who joins us now. G'day, Peter. Thanks for joining us on the Savings Tip Jar.
Good morning, Dominic and Denise. Very nice to meet you.
Now, let's just get straight into things, Peter. Now, give us your overall impression of last night's federal budget. Go for it.
Well, I must say I've been following budgets for 40, 50 years, but this is the worst one I've ever seen in my life. It would always do exactly the opposite of what it should be doing given its aims. It wants to improve housing affordability and housing supply, improve the position of renters, in particular the younger generation. So what does it do? It does the exact opposite. It cuts off the only supply of rental housing, which comes from private investors, and it's impossible for them to invest unless they can deduct the cost of borrowing. For every other kind of investment in Australia and around the world, interest cost is tax deductible. It's a cost of doing business, and those interest costs have gone through the roof due to government-induced inflation. If you can no longer deduct interest, then there'll be no investment in rental housing. Now, admittedly, the government realises that, so they've exempted new investment. But investors aren't stupid. They know perfectly well that once their house is built, it's not new anymore. It's existing. And that can be stolen. So the rules will then be applied retrospectively to those new investments. So no smart person would invest for rental purposes, given that it's impossible to believe anything that the government says. They've been saying for many decades that there will be no such measures, that these interest expenses will be tax deductible despite the so-called losses that they temporarily create. It's the opportunity for wealth creation by the younger generation, so they've deliberately denied the next generation the ability to invest in housing, and this is going to destroy their wealth opportunities. So it's very hard to find anything to like in the budget. The only thing one could potentially like are the alleged hundreds of billions of dollars of saving on NDIS, but one knows perfectly well that this is just a mouthing of platitudes. They're not actually seriously going to do it. They can't possibly do it because they've set up the structure in such a way that it's just going to get worse and worse and worse.
Well, Professor, you've obviously not holding back there. Worst in 50 years is quite some statement. You've somewhat already answered the next question, which was, was this really a budget about, the framing it as the intergenerational equity or fairness? Can you elaborate on that aspect? Like, why do they think this is about intergenerational equity, but you're saying it's not? It's actually not great for young people, this budget.
Well, there's never intergenerational equity in the sense that the older generation, people's parents, are by definition richer than their siblings and the young, because they've had a whole generation to save and invest. If investment returns were negative or zero, then we would have intergenerational equity according to the government, but thankfully we don't. So the government says this is beneficial to intergenerational equity because it supposedly takes away the opportunity for older people to invest, taxing capital gains at a higher rate and taking away the opportunity to get temporary negative returns. But how does this benefit the younger generation? It's not going to lower the cost of housing. In fact, the cost of housing is going to get a lot worse. Inflation is going to go on rising. The cost of building is going to go up. All the government budget measures, such as subsidies to provide 5% deposits for younger people, which is their measure for intergenerational equity, is completely nonsensical, because all that does is push up the price of housing. And moreover, not only are Australians eligible for these subsidies, but the million or so new immigrants coming in, they're also eligible. So Australians are going to see the price of housing just escalate through the roof. There's very little new supply, and millions and millions of new immigrants are adding to demand, and all the tax changes are making it impossible to construct new housing for rental purposes. So it's very hard to see any intergenerational benefits here. In fact, it's hard to see any. The only winners really are One Nation, are going to get a lot of support as a result of this budget.
Well, you've touched on quite a few. We've seen what you've said about housing, and you're right. Politically, it will probably give rise to some sentiment on that side of politics. But what are sort of probably the unintended knock-on consequences that we might see apart from the short term if this is to remain in train? What about some of the long-term things you see?
Well, I can see investment shifting out of housing, and so there will be increased demand for equities and other kinds of investments of that sort. So we might see stock prices going up and people investing in ETFs and so on. And we now will have the highest tax on capital gains perhaps in the world. It's not going to raise additional revenue really, because the new scheme just reproduces the scheme brought in by Hawke and Keating 40 years ago, which was actually my proposal, which so that government adopted two of my proposals. First of all was the indexation of capital gains tax, which is what they implemented. And secondly, the franking credit benefits, which shielded people from double taxation. At least they're going to preserve those benefits. They wanted to take them away a few years ago, but they haven't taken them away this time. So the only way to avoid the much higher minimum capital gains tax rate of 30% is not to trade, not to sell assets, because they can't. They were tried to tax unrealised capital gains, but that failed. So capital gains are only taxed on realisation. So we're going to see less trading, higher dividends because companies don't want capital gains, so they'll pay out more cash to through dividends, and there'll be less trading in the stock market to lock in so as not to realise capital gains. And budding entrepreneurs and so on, you know perfectly the best thing to do, which is to go to Singapore or to the US or in virtually any other country, where even New Zealand, where capital gains are either not taxed or taxed at very, very low rates.
Yeah, I suppose there is a real fear that we might see a lot of our sort of best and brightest minds who are looking to, innovate, start new businesses, the startup culture. Perhaps they'll be less inclined to do that here in Australia, maybe head off to the likes of the US. So that's a real concern, obviously. But, trying to be devil's advocate a bit here, the devil being the government in this case, their argument probably, I'm guessing, on the sort of intergenerational equity front is that these changes to capital gains tax treatment and the negative gearing are to slow down the price of housing. But you're saying that is doing the opposite. Why might that be if for example, they're preserving the negative gearing tax concession for new supply, and then same with the 50% capital gains tax discount, which people buying new builds will still be able to take advantage of? Won't that drive up demand for new properties and hence increase supply in the market?
Well, no, I don't think so, because it's just taking away, as I said, it's taking away existing benefits, and it's done so after they've denied that they would ever do this. As I said, if you or I are making an investment, you need to understand not only what the tax laws are now, but what they will be in future, especially when you try and sell some asset perhaps in 5 or 10 or 20 years' time. So by its nature, investment is long-term in that sense. So you anticipate or try to anticipate what the rules will be in future. Now, clearly the government has said, never believe anything we say because we are just lying to you, and we will change our minds unexpectedly whenever it suits us. So this massively raises uncertainty and therefore makes investing much more risky. Now, the risk cost is the major cost of investing. And so for that reason, we'll see less investing, certainly less investing in housing where it's most needed and where we have the most crisis elements due to massive increases in immigration. So I just don't think that they can legitimately claim that their attempts to prevent the worst effects of their measures are really going to enable investment to go on. They're not.
Just switching the topic now to a bit of the old school sort of economics sphere. Will this budget, what will it do for what we're told is very critical for the economy, and that's lifting production and curbing inflation? Is this a piece of that puzzle, or has it got it wrong?
Well, the government clearly knows what it has to do to reduce inflation. The RBA has been saying this for many years. Every economist has been saying this. One Nation and other parties, certainly Liberals, have been saying this. And the way to reduce inflation is very simple. Stop spending. So what has the government decided to do in this budget? It's decided to increase the rate of expenditure even faster. And how can it do that? Well, because it's deliberately maximised the gains from lack of indexation of tax rates. So by pushing up inflation, every year it raises tax rates by 6% or more, with a new 37% rate makes it worse. And so the government is really the only beneficiary from inflation, because every tax goes up by more, and taxes aren't indexed, and tax rates aren't indexed for inflation. And so that's why the government has decided to raise taxes by $78 billion, taking even more out of the private sector, crowding out the private sector. All the productivity gains come from the private sector. They've been crowded out. Public state investment and government investment dominates all investment, drives out private investment. So there's very little private investment. All of these things are designed to make inflation worse, and the only beneficiary from inflation is government coffers. And so by continuing spending more, if you look now at the states as well as federal, we'll see that government expenditure is hovering around 40% of GDPs. That's the highest it's ever been in Australia's history. And it's absolutely outrageous when you consider the $200 billion deficit of Victoria is spent on mostly useless investments. A lot of it is going off to corruption. And all these state debts will have to be absorbed, taken over by the Commonwealth, because the states have no way of repaying these huge debts. So in every direction, we're seeing more and more government expenditure made at the expense not of the current generation, but future generations. So they've targeted the unborn generation as the victims here. So we're getting intergenerational assault, especially on the unborn generation.
Mm-hmm. Yeah, well, because that all that debt needs to be repaid somehow at some time. And, you know, in my younger years where I often thought, oh, why should we be so worried about government debt? And my dad said, oh, because you guys will be paying it. Yeah, really, will we? I don't know. But then I'm feeling it now with, you know, not through like direct tax increases necessarily, but just through bracket creep. And, you know, it's that stat that we've been discussing a bit where, you know, we've heard that I think it's gone from being like 1 in 50 Australians were in the top tax brackets in like 2007. Now it's closer to 1 in 5, which is very telling and just shows that the creep and how that it really insidiously.
Well, you might not be aware of the fact that you might think that hospitals and all sorts of deserving groups are benefiting from higher government expenditure, but in fact, by far, apart from the NDIS, the most rapidly growing element of government expenditure is interest on the $1 trillion debt.
True.
So that's taking away from hospitals and from the police. And Victoria, law and order is broken down. They can't afford even to have a police force anymore. And so police are resigning en masse. So you're going to see that interest on this $1 trillion debt, there was more than $1 trillion when taking into account the states, it's much higher, is going to absorb all the good things that we look for from our states and local governments.
Yeah, we've been quite hard pressed to find any sort of positive takes on this federal budget lately, but yeah, it's I guess that there are some hard truths that need to be spoken, and hopefully the government is listening to conversations such as this one, and they're taking on that feedback for the next budget, which maybe, I don't know, we've sort of been speculating maybe that given it's a pre-election budget, there'll be some income tax cuts, or, which I would love to see, indexation of the tax brackets. But yeah, we'll have to wait and see what happens, particularly what Angus Taylor says in the budget reply tonight.
Fraser actually implemented indexation of the tax brackets. Malcolm Fraser, you remember, how long did that last? Well, as soon as he realised he actually had to pass laws to get to take more money from the public, he abandoned it. So,
I'm sure the Treasury wasn't too keen on that either.
No, they wouldn't have been keen on it at all. And it's the chances of that happening. What we're going to see is, we might even see the government gave a great handout, 68 cents a day to workers. To buy in a week, they could save up to buy 1 cup of coffee. So we're going to see more handouts of that coming up before the election. Maybe 2 cups of coffee a week. That would be great. Okay. I'm looking forward to that.
I think, yeah, the voting public, you would hope, are a bit smarter than that and can see through that. And I'm seeing some of that sort of reaction to the $250 tax offset that you don't get until mid 2028 at best. I think a lot of people, it's just a bit of a slap in the face. Like, what's the point of that? But
last time they promised a very sizable tax break, they kept saying until the very last day that this massive break would take place. And then, of course, they banned it at the last minute, as they do everything else.
Stage 3. Yeah. There was some big shake up there. Well, yeah, Professor, you've been very generous with your time there, but really appreciate your insights. Thanks so much for joining us on the Savings Tip Jar podcast.
Thank you.
Thank you very much. Okay. Bye, Dominic. Bye.
Yes, that was Emeritus Professor of Finance at the University of New South Wales, Peter Swan. And that brings us to the end of another episode of the Savings Tip Jar podcast. Thanks very much for listening. Thanks, of course, to our sponsor, Savings.com.au. Thanks, of course, to our guest, Professor Peter Swan. And thanks to my co-host, Denise. If you guys like this episode, please give us a 5-star review on Spotify or Apple or whichever podcast platform you're listening on. If you have got anything you want to say to us, if you want to share your thoughts on the federal budget and how you're impacted, or got any questions or comments or feedback, get in touch with us via our email. That's inquiries@savings.com.au. That's inquiries with an E. Do follow us on social media. That's savings.com.au on Facebook, Instagram, Twitter, TikTok, and LinkedIn. And catch you next time. Thanks. Goodbye.